At the end of every week, DukascopyTV interviews a special guest to discuss the major happenings next week and potential market movers. For today's Week Ahead, I'm joined by Ankita Dudani, an FX strategist at RBS in London. So Ankita, we've got several rate decisions by central banks across the globe next week, but what else could be causing a stir in the markets?
Well, despite the various central bank rate decisions, without fail, events out of the Eurozone will remain the main driver of asset market. The main focus undoubtedly will be how negotiations are developing in Greece between the Troika and the various bondholders. Agreeing on a voluntary participation is a prerequisite before the second bailout for Greece can be passed, and this is crucial to keep the country solvent for the March 20 bond redemption deadline. So there are still lots of moving parts which needs to align before any positives can be drawn. And the two immediate challenges on that front are, firstly, what will be the percentage of haircut in NPV terms, and second, whether it will be voluntary or not. So now we did see some overnight reports which suggest that a deal on Greek PSR is close. But time is ticking, and according to our estimate, they will need about 6 weeks post any PSI agreement to get everything done and dusted with. So, and on the other hand, if the PSI is not voluntary and it's forced upon creditors, that's where the real issue comes in, and because it will trigger a CDS event, and contagion risk will be huge with far-reaching implications. So apart from Greece, we also have the initial estimates of PMIs, both manufacturing and services out of the Eurozone, which will be watched closely to see how much of additional support will be required by the ECB in order to support the region. Then we do have some Euro area and EU finance ministers meeting early in the week, which is ahead of the Jan 30th summit. So usual focus on these meetings, and just finally some potential update following this week's G20 Deputy Finance Ministers meeting on the proposed increase in the IMF's lending capacity by $500 billion, this is also something which market will be focusing on.
Data published earlier this week revealed UK unemployment rose to a 16-year high in the quarter through November, although UK inflation slowed to a 6-month low in December. The UK is dealing with tough spending cuts and dampened consumer confidence, and as a result there's growing concern that Britain is heading for another recession amid the European debt crisis. Now, UK GDP growth figures are released next week. What's your stance on monetary easing by the Bank of England and your outlook for Britain's labour market, as well as growth for 2012?
For the Bank of England, obviously, it's pretty clear that the UK economy is struggling, and we will need to see some more support from the Bank of England. The UK inflation number, as you rightly said, eased to 4.2% in December, which was driven by some powerful energy price base effect. And this 4.2% suggests that the Q4 average for CPI has now come in line with Bank of England forecast, and this leaves the door open for the Bank of England to undertake a further round of asset purchase, and we look for 50 billion sterling to come in as early as next month. So the Bank of England clearly is in a dovish stance, and the policy rate will be left unchanged for the foreseeable future. In terms of labour market and growth, labour market definitely is set to struggle because as austerity bites, both the public and the private sector will be shedding labour in order to cut costs and make ends meet. So, and obviously a continued improvement in labour market is a prerequisite for sustainable economic recovery, as consumer spending will no longer be driven by savings drawdown. We need to see employment pick up because consumers will start using the salaries to make new purchases. So that's not happening in UK anytime soon, and as a result of which our GDP tracker estimates that UK economy will grow only by 0.1% in the final quarter of last year, which is released next week, and with expected recession out of Euro area, the softening of exports to that region will also have an impact on our growth. So for 2012 as a whole, we expect growth to be similar to 2011, and we look for plus 0.8% for the entire year.
It's another busy week in terms of market mover releases out of the US. Now, economic improvement in the US actually seems to be weathering better than Europe at the moment. Is It's a big election year in the US, of which Americans will be focusing on economic recovery in the decision process for a new president. In terms of growth and confidence, are you expecting this to pick up in the US? And what type of macroeconomic picture do you see for the US by the end of 2012?
We do not expect growth to accelerate meaningfully further in 2012 from its recent pace. For 2012 as a whole, we look for real GDP growth of only around 2.5%, which is not going to be too far behind from what we saw in 2010 and 2011. One of the reasons is the outlook for fiscal policy in the US is extremely unclear, particularly given the failure of the Joint Select Committee to reach an agreement in budget savings last year. So uncertainty surrounding the presidential election in November this year could encourage a wait-and-see attitude amongst investors, and businesses can be pushed to the sideline until they have more clarity. So we would not be surprised to see some settling back in the pace of activity probably in the second quarter of this year. We think the economy will be left alternating between periods of strength and periods of weakness with no decisive up or down trend. And just finally, in terms of Fed policy, we think the elevated unemployment rate in US will lead to more monetary support. And according to our estimate, we think the Fed's balance sheet could expand by another $500 billion to $600 billion in this year.
Thank you very much for that, Ankita. I'm afraid that's all we have time for today. To keep on top of all the market news, stay tuned to DukascopyTV. But for now, goodbye.